Hey guys, welcome to Module 1. This is Financial Accounting for MBA. So I want to begin this course by making one thing clear. It's not a course that's designed to turn you into accountants, but it is designed to help you become better business decision makers. So accounting is often called the language of business, and that description is useful because virtually every major business decision eventually has some kind of financial consequence. Whether you're working in operations, marketing, healthcare, HR, entrepreneurship, finance, technology, general management, any of that, you're eventually going to encounter financial information that you need to interpret. So my goal throughout the course is for you to become more comfortable looking at accounting information and ask meaningful questions about the business behind the numbers. So in this first module, we're going to establish the foundation for everything that follows. So we'll look at the major activities that businesses engage in. Um, who uses accounting information, the four primary financial statements, some basic profitability measures, and the competitive environment that helps explain why companies perform differently. And as you work through the module, I do not want you just memorizing definitions. I want you asking, what does this information tell me about the company? And why would a manager, lender, or investor actually care about it? That's the mindset I want you to develop from the beginning. So the publisher of the book talks about identifying three major types of business activities: operating, investing, and financing. So those are also three that follow the statement of cash flow. You'll see that later, but that's where your cash is derived, either in the operating activities, your day to day, or the investing that you're doing within your business on property, plant, and equipment, or any financing activities, whether you're borrowing or paying back different loans or lines of credit. So when we talk about operating, these are essentially the activities involved in running the company's core business. So if you own a retailer, operating activities include buying merchandise, selling that merchandise, paying employees, collecting money from customers, paying suppliers, advertisers, paying rent, providing customer service. If you own a consulting firm, operating activities involve providing services, paying employees, billing clients, and collecting receivables. So when you hear the term operating activities, think, what does this company actually do to generate revenue? And next are investing activities. Investing activities typically involve acquiring the resources the company needs to operate and to grow over the long term. That might include buying buildings, equipment, technology, and other companies. Suppose you run a manufacturing company and spend about $50 million on a new production facility. That is an investing decision. You are using resources today because you expect that investment to help generate benefits in the future. And the last area is financing activities. And these answer the question, where did the money come from? Companies generally obtain financing in two broad ways. They can obtain money from owners, which we call equity financing, or they can borrow from creditors, which creates liabilities or debt. That distinction becomes extremely important later because debt and equity have very different consequences for risk and return. So I want you to remember the framework. Businesses operate, businesses invest, and businesses have to finance those investments and operations. Those three activities form a useful framework for understanding almost everything we're going to see in the financial statements. So who uses the accounting information? Um, Basically, that's the question we want to know: who actually cares about all that information? And the answer is a lot of people. Um, there's many users of financial accounting information, including managers, employees, investors, creditors, suppliers, customers, regulators, and even voters and policymakers. Let's think about these users from a managerial perspective. An investor may want to know, is this company profitable? Is it growing? Is management using resources effectively? What risks does the company face? And a lender might ask, will this company be able to repay us? How much debt does it already have? Does it generate enough cash to make interest payments? A supplier may want to know whether the customer is financially healthy enough to pay its bills. But that's basically what it is. Also, where does the information come from? For publicly traded companies, there's two documents that are especially important. There's the Form 10K and the Form 10Q. So the 10K is the company's annual filing, and the 10Q is the quarterly filing. The 10K contains the audited financial statements, explanatory notes, management of discussion, analysis, and other important information. And the 10Q is the quarterly filing. It contains condensed financial information and other disclosures during the year. For MBA students, you guys need to know that these reports are valuable because they allow you to move beyond that textbook examples and look at actual companies. So the 10K is the annual and 10Q is quarterly. If you want to understand what's actually happening in a company, the 10K is probably the first place you should look. The four financial statements. This is the heart of financial accounting. There's four primary statements. The first is the balance sheet. The balance sheet reports all the company's financial. It reports the company's financial position at a specific point in time. So here's your net worth as of December 31st, 2026. Well, that means everything you did in all the years prior to that, as of this date, this is what you're worth. You acquired things, buildings and property and plant. You earned money, and that income you earned, the net income off the income statement becomes earnings you retain or retained earnings. That's how it flows together. So it's basically a financial snapshot. You'll know it by the equation assets equal liabilities plus owner's equity. And so assets are the resources the company controls, and that could be cash, inventory, accounts receivable, buildings, equipment, and other resources. And those assets had to be financed somehow, though, and they were either financed by creditors or they were financed by owners. And that's the creditors, the liabilities, and your owners is your equity. And that's why the equation always balances. Your assets show what you owe. Your assets are here, and you either owe or own them. That's the difference. Your assets are what you owe or own. It tells you that. So assets equal liabilities plus owner's equity. So the second statement is the income statement. The income statement reports performance over a period of time. The fundamental relationship here would be revenue minus expenses equals net income. It gets a little more complicated by that, but it's any money you take in minus any money you pay out gives you your net. This statement helps tell us the company's business activities generated profit during that period, but I want you to remember something right now, and it's very important. Net income is not the same thing as cash. We will talk about that later. But there are accounting adjustments that you can do, and net income does not equal cash. That's sort of what statement of cash flows helps us with, is reconciling between our cash balances and net income. So the third statement is the statement of stockholders' equity. This statement explains how equity changed from one period to the next. It includes owner contributions, retained earnings, and other equity components. Retained earnings is especially important because it reflects cumulative profits retained in the company rather than distributed to shareholders. The fourth statement is the statement of cash flows. This statement tells us where cash came from and where cash went. And notice something else. It will organize everything into those same three categories we talked about earlier: operating, investing, and financing activities. So why you need all four statements? The important thing to know is no single financial statement will tell you everything you need to know. Imagine a company reports record profits, and that is great. But suppose the company's not collecting cash from its customers. Its AR receivables or accounts receivable are growing dramatically. So you're recording profit, but you got no cash. It's a you credited sales, you debited AR. You showed, hey, revenue, sales revenue shows up on the income statement. You can do that all day long. But accounts receivable, you still got to collect that money. If you're not collecting the money, ultimately you do not have profit. So the income statement looks strong, but the cash flow picture's concerning. So imagine a company has a very large cash balance. That sounds great, but perhaps it had to borrow billions of dollars to generate the cash. So you have to see that on your cash flow statement, the operating, investing, financing. If you're losing money on the operations, but you're borrowing lots of money on the financing, it's going to look like you have a lot of cash in the bank, but it doesn't. You got to know where the cash came from. So the balance sheet and the statement of cash flows help reveal that. And that's why professional financial analysis requires us to look at all the statements together, because each one tells a different part of the story. So we need to understand the balance sheet economically. So I want you to begin thinking about the balance sheet in an economic rather than a purely accounting way. So when you think of assets as resources that provide future economic benefits, that helps explain that relative mix of short-term, long-term assets, depending heavily on the company's industry and business model. Think about a technology company compared with an airline. An airline requires enormous physical investment in aircraft and other long-term assets. A software company may require much less physical capital. So if you compare the asset structure of those companies without considering their business models, the numbers can be misleading. So this is one of the themes you'll see repeatedly throughout the course, is that context matters. So there's profitability that you got to consider. And that's return on assets and return on equity. ROA or ROE are some of the ways that you can measure that. So return on assets looks at profit relative to the resources invested in the company. Basically to ask, how effectively is the company using its assets to generate earnings? That's return on assets. How efficient, how effective are we with our assets in generating income? Return on equity asks, how much return did the company generate relative to the shareholders' investment? So let's talk about a very simple example. Suppose a company A earns 10 million and company B earns 20 million. So at first glance, company B seems a lot more successful. But now company A has 50 million in assets and company B has 500 million in assets. Well, company A generated 10 million using only $50 million of resources, but company B generated 20 million using 500 million. So the comparison looks a lot different. That's why analysts frequently use those ratios rather than simply looking at an absolute dollar amounts. Ratios help but put performance into context. And I want to emphasize this now because it's going to become central in Chapter 4. Calculating the ratio is not the analysis. The analysis begins when you ask why that ratio looks the way it does. It's understanding what's going on. You always have to ask questions. So accounting, one feature about this chapter is that it doesn't treat financial statements as though businesses operate in a vacuum. One thing it discusses is Porter's 5 forces and SWOT analysis as frameworks for thinking about the competitive environment. So Porter's 5 forces include industry competition, buyer bargaining power, supplier bargaining power, the threat of substitutes, and the threat of new entrants. Why does that matter in an accounting class? Because those competitive forces eventually show up in the financial statements. Suppose customers have enormous bargaining power. What might happen? The company might have to lower prices. That could reduce revenue and profit margins. Suppose suppliers have enormous bargaining power. Input cost may rise. That could increase cost of goods sold and reduce gross profit. Suppose a company develops a highly differentiated product protected by patents. It may have the ability to charge premium prices and earn higher margins. So the financial results are really the output of the company's competitive strategy and operating environment. That's why a strong financial analyst needs to understand both the numbers and the business behind those numbers. So looking at it from a manager's lens, why did profitability change? So think about you're the CEO of a company and your operating profit margin declines from 18% to 12%. A weak analysis would say operating margin declined by 6 percentage points. That's technically correct, but it's not very useful. A stronger manager begins asking questions. Did our selling prices decline? Did our raw material cost increase? Did labor costs rise? Did new competitors enter the market? Did customer preferences change? Did we change our product mix? Did we make a strategic investment that temporarily increased expenses? The accounting information tells us what happened. Managerial analysis tries to determine why it happened and what we should do next. And that distinction is going to matter during this course. So, another important part of the chapter is that the four financial statements are only part of the information available to users. Public companies also provide financial analysis, statement notes, management discussion and analysis, audit reports, proxy statements, and other regulatory filings. So those disclosures matter because financial statements contain summarized numbers. The notes in MD&A, management discussion and analysis, often explain the story behind those numbers. If revenue suddenly declines, the MD&A may tell you why management believes that happened. If debt increased substantially, the notes may explain the terms of that borrowing. If the company changes an accounting policy, the notes may help explain that change. So as you become more sophisticated in this course, you will begin moving beyond simply reading the face of the financial statements. Overall, what you need to figure out in this module, you need to understand the difference among operating, investing, and financing activities. You need to know the purpose of each of the four primary financial statements. You need to understand the accounting equation, assets equal liabilities plus stockholders' equity. Recognize the net income and cash flow are not the same thing. Understand what ROA and ROE are trying to measure, and understand that financial performance must be interpreted in the context of the company's strategy, industry, and competitive environment. Recognize that strong financial analysis goes beyond asking what happened and moves toward asking why it happened and what management should do next. So that last point may be the most important. The course is not about memorizing a collection of accounting terms. It is about learning how to use accounting information to understand business performance and make better decisions. That is why I want you. That's what I want you carrying with you as you move toward the next module.